Can you see? I just entered right now. Director, it's in profit, right? A very huge profit. Like, oh my goodness. Guys, this is my entry criteria, okay? And it's currently in huge 3,000. Okay. That's a story of another time. So I'm going to show you the exact entry criteria that I use anytime I plan to trade demand and supply. You see, guys, the essence of this video is purely for educational purposes. And I want this to go on record that trading in the financial market carries a significant degree of risk. It is very imperative, very key, very important for you not to handle things casually, because anytime you handle your finances casually, there are basically casualties in your bank balance, and you don't want this for yourself. This is the Blue Bull Forex, of course, your #1 author of the blue color in your MT5, and the essence of this video is to teach you and guide you on an easy strategy that so many people underlook when we are trading in the financial market, to be precise, the foreign exchange market. And the strategy that we are exploring today is called supply and demand. Okay, supply and demand. So easy. What do we mean by supply and what do we mean by demand zone? The supply zone is basically a point of interest where we are looking to sell. Okay, selling means letting go in exchange for something. Okay, now buying, or where do we look for buy opportunities in this particular approach, is basically at the demand zone. Okay, if something has high demand, of course you will be tempted to buy something that has a high demand. And if something is being supplied, you also want to supply, or you want to sell that specific product, and that is how business works. So today we're going to be breaking it down. How do we trade supply and demand? All right, now to the chart. A supply zone or a demand zone, all right, is a point. Oh my goodness, this is not visible well. I have to change this to white. My director, please pardon me for that. Now, assuming this is visible, you see, where the market consolidates before an impulsive move to the downside, this particular zone is called a demand zone. Okay, this is called a demand zone. It's called a supply zone, sorry. Supply zone. The implication is the market ranged within this particular zone, and then it gave us a directional bias to the downside. Now, where the market consolidates before an impulsive move to the upside is basically what we call a demand zone. Okay, a demand zone. Now, if you pick, there is something we call Fibonacci retracement tool. Fibonacci retracement tool. If you pick a Fibonacci retracement tool and put from the highest point, oh my goodness, these are different Fibonacci. All right, that should be the Fibonacci that you should use at this particular level. Well, if you pick your Fibonacci from the highest point and drag it down to the lowest point, it is supposed to give you this kind of an approach. We have 0.5. This is black. I don't know why. It should be white. It should be able to give you the 50%, the 100%, and the 0 mark. 100% means equilibrium zone. Okay, this one means equilibrium. And then this means the lower part, or the demand zone, is called the discount zone. And the upper part is called the supply zone, or it's also called the premium zone. All right, now let me make this make sense in a layman's language. The nature of the business, any kind of business that you do, is designed in a way that you are supposed to buy whatever product you are dealing with. May it be clothes, may it be construction material, might it be, what else do people, might be mobile phones, accessories, whatever you deal with, you want to buy that particular product at the least possible price. Okay, if for example you sell this kind of a phone, you want to buy this phone possible at 15,000 Kenya shillings and sell it at 150,000 Kenya shillings, because what we call profit margin is the discrepancy or the difference or the gap between the buying price and the selling price. All right, so if you buy low and you sell lower, you make a loss. Okay, and that particular loss is what in Forex we call drawdown. If you buy low and sell high, you make a profit, because if you do a math between what you bought at and what you are selling at, you discover that there is a gap in between. Now, how people are made, they always want to buy cheap things, but they want to sell expensive things. This is basic human psychology. All right, everybody wants to buy things at a cheaper price. All right, everybody apart from content creators on TikTok, everybody else wants to buy things at a relatively discounted price, and then they want to sell it at a higher price. Now, how does this work? If, for example, you are dealing with any product and it is discounted, discount zone, I'm explaining the discount zone. It means this product is being sold at a cheaper price. For example, if the cost of this phone is 150,000 and then I come and sell it at 20,000, it means I am giving around 80% discount. Oh my goodness, I wish that was such. Now, if I'm giving this kind of a discount, it means this particular product is too cheap at that particular point, and the best thing to do is to buy it at that particular point. Now, woe unto thee, son of man, if you are the one who is selling at the discount. If you sell at the discount, implication is you are doing this probably to attract customers, but not to make profit. All right, so if you buy here at the discount zone is when you make profit, but when you sell at the discount zone, it means you are selling at a loss, because you have already discounted the product way more than its actual selling value. Now, everybody wants to buy at the discount, so the discount is a demand zone. And at the demand zone, we are specifically looking for buy opportunities. Please let this go on record that we do not sell on demand zone. We do not sell at the discount zone. We only want to buy because we want to be the smart people in the game. So at the discount zone, we're strictly looking for buy opportunities. And now once we come to the other part, which is the premium zone, premium means expensive. Honestly, everybody wants to deal with expensive things when they are selling. Okay, given a chance, people who sell second-hand clothes would work for companies that sell much more expensive things like private jets or even custom-made cars like Bugatti and the rest. So would you choose to be selling yogurt, or would you choose to be selling private jets? Of course, you will choose to go and be selling private jets given a chance to be hired by either Delamere or another company that probably makes private jets. So you want to deal with the most expensive stuff at the time of selling. So this means at the premium zone, we are strictly looking for sell opportunities. If we spot any buy opportunities at the premium zone, it is a red flag. Okay, it is the weapon formed against us, and woe unto us, because most of the times that weapon tends to prosper. Now, when we come to the equilibrium, it has equal. Okay, right, that's mine though. It means like demand is equivalent to supply, and when demand is equivalent to supply, there is no business. Okay, because the actual business is the discrepancy between the demand and the supply, for the supply to be for the demand to be fed by the supply and the supply to feed the demand. So at any point we have demand and supply being equivalent or at the equilibrium, we do not engage the market. So please pay attention. Never buy any price at equilibrium. I'll guide you on how to set this Fibonacci to look like this one of mine. It's a 2 seconds thing, but that will be later in the video. Not even later, it's right now. If you want to make this kind of a Fibonacci tool. You come to the settings of Fib, just uncheck any other box, check 0, check 1, and check 0.5, and then say, okay, it should exactly look like the one that I am showing you over here. Simple, simple, simple stuff. Now let's look at, for example, how do we get a demand? Where the market consolidated, then followed by a rally, that's a point of interest. And I'm showing you my entry criteria. My entry criteria is what I'm showing. And guys, I am very, very, very dangerous with entries. Can you see? I just entered right now. Director, it's in profit, right? A very huge profit. Like, oh my goodness. Guys, this is my entry criteria, okay? And it's currently in huge 3,000. Okay. That's a story of another time. So I'm going to show you the exact entry criteria that I use anytime I plan to trade demand and supply. Now, how do we do that? The first thing is we want to mark out a zone where the market has ranged, and then from that specific small range, we had a rally either to upside or to the downside. But before that, can I just show you types of demand and supply that we have? The first one, we can have a range, okay? We call it base. Then we have a drop, and then we have another base. So this one is called base, drop. Oh my goodness. Base, drop, base. Okay, simple. Guys, let me break it down to you. See, I make trading the simplest thing on earth. Like, if I teach you how to trade and you still cannot get it, I highly recommend you don't attempt it again. I highly recommend we do more farming and other stuff, because there is no other way. It can be made much more easier than what I'm just gonna show you right now. It's very easy, all right? And I am sure you have the capacity and you're in the best state to capture this. So now pay attention, because I'm gonna make it so easy, and whatever I'm teaching you guys is not philosophy. It's not theories that I have seen online. It is what I have been doing every day for my daily living. Okay, now let's go back to the charts. So when we have a base, and then we have a rally to the downside, and then followed by another base, this means one thing, that this particular point of interest here is our possible supply zone. The implication to that is we want to wait until the market taps that zone, and then it shall drop from that particular point. Okay, now the other one is demand. We can have a rally, we can have a base, then we have a rally and a base. So this one is called base, then we have rally, and then we have another base over here. Okay, another base. Simple. Now the direct implication to this would be us marking out this particular point of interest, and then patiently waiting for the market to retrace and tap it before an impulsive move again to the upside. And this is how we trade a demand. This is how basically we trade a demand zone. This is how we trade a demand zone. A demand zone, okay, a demand zone. And then the other one that we had previously was trying to explain a supply zone. Okay, very easy stuff. Like, this thing is not supposed to be complicated at all. Now let's break it down further to an actual chart work. Right now, look at this kind of a movement. Let me drop those down. You see, we had a consolidation here, then followed by a very unusual rally, resulting to a series of imbalances. All right, if you understood most of the videos that I've recorded, I've talked about imbalances more than anything else. I've talked about buy-side inefficiencies, buy-side imbalances resulting to sell-side inefficiencies, which we call BC, and CB, which means sell-side imbalances, which results to buy-side inefficiencies. Now, for example, this kind of a market from here went all the way up, right? Now, this kind of a range which happened here is not a coincidence. Now look at me. This is the most honest version of me. Okay, there are no coincidences in the market. Everything is calculative, everything is calculated, and every candle has a meaning. Every price action is designed to do a specific task or action. It's not a coincidence that it's buying when you sell and selling when you buy. Okay, it is designed exactly that way. It's not coincidence. Now let me show you what I'm trying to talk about. So here we have a range. From where we have this range, remember it's in the 4-hour time frame. The first thing, because now we are combining two very critical concepts. First concept is demand and supply, and the second concept is called the multi-time frame analysis. Now let me break it down. We want to mark the whole zone as our point of interest, like that. Okay, let me show you how easy this thing is done. Now once we mark the whole zone, which is the whole demand zone, which has rallied, the second thing we want to narrow down to 1 hour time frame. Okay, I want you to try and copy these exact criteria. Narrow down to 1 hour time frame. When you narrow down to 1 hour time frame, pick your Fibonacci tool again, measure from the lowest point and the highest point. You will discover one thing. It is still giving us a discount zone. It is still giving us an equilibrium, like we said. Equilibrium. And it is still giving us what we call the premium. We said at the premium, we are specifically looking for sell opportunities. Now, let's break this down. At the premium, we don't want to engage the market, and at equilibrium, we don't want to engage the market. So what do? We pick another fib, we pick a rectangle here and mark only this zone, because we are looking for buy. We are not looking for a sell opportunities, because what we saw is a demand zone, not a supply zone. So we then delete the initial shenanigans. That easy. All right, we then delete this easily. We only remain with this one. Now again, we are trying to narrow down and be the intelligent people that we are. We want to minimize the risk and maximize on the profit. Okay, so again, we want to narrow down to 30 minutes time frame. And because we are good people, at the 30 minutes time frame, again, in still the range that we captured from 1 hour time frame, we want again to pick the fib again and measure from that way. And when we measure that way, it's giving us the discount zone again. This is the discount, and equilibrium and premium. And because we are strictly interested only on the buying part, we do not want to buy at the premium side, and so we only want to pick the discount region, that one, and we're gonna have it this way. Now, this is a huge thing that happens here. This is a huge thing that happens. Now, from the 30 minutes time frame, we can narrow down to 15 minutes time frame if you want, but then let's try to measure the number of pips that we have, and we discover we are risking around 47 pips, and we are targeting, let's say, what are we targeting? We are targeting probably the previous high, which is around 500 pips, and that is a so huge risk to reward ratio, which makes sense. So we can give this a benefit of doubt and say, let's try to work with the entry from the 30 minutes time frame. But then we have to remember one thing: it's better to reduce your risk further. And so, because personally I am not risk aggressive, I am very risk averse, I would still not work with the 30 minutes. I'll work with the 15 minutes. And so this tells you I'll narrow down again using the same concept, and then I will pick the most discounted which is the one that is below. Okay, and look at the difference, and I want you to see the difference between these two entries. So the first person would enter from here, will wait for a long position there, and our stop loss is down over there. We want to have our stop loss there, and we are targeting let's say this key zone, which was broken initially. So that is the first entry criteria. Now the second one, who will be me, will enter from the smaller part, which is basically the 15 minutes entry level, and then from the 15 minutes I'll put the stop loss exactly almost at the same place, and I'll target the previous high. Now see, this one is 1:4 risk to reward ratio. The other one is 1:3 risk to reward ratio. All right, so as you can see, there is a very huge difference, and then we're gonna replay this and see how it's gonna go, and see whether we're going to catch a trade. Let's see if we are going to get a trade. So the market is playing out. Market plays out in the 15 minutes time frame. Assume right now you are still waiting patiently for the market to come to your entry. All right, I can replay from the 1 hour time frame so that we can move faster. We are waiting for the market to come and touch those two zones. Okay. Oh, market went to even. We are so patient with our entry. We are so patient with our entry. Like so patient. All right. Hey, I'm replaying. All right, it's now approaching to our entry zone. All right. This is probably 2 decades later, but don't worry, it's a waiting game, right? So let's see how it's gonna play out. I'm gonna still hold to my entries. Hey. All right. Good. So these are where my entry zones are. There is that one as it over there, and then this one as it over there. All right. Now, so these are both entry zones. So let's see if the market hit the take profit. Oh, boom, and that's how simple the market hit TP. All right. So as you can see, this one had a smaller risk, and both entries were actually activated. But now going with this one, as you can see, it was a very smooth entry from this particular zone, which was our point of interest for the buy. And so probably would have targeted even the previous high, and the market will still go to your previous high. All right, let's see if it did. Previous high. Oh no, it is yet. No, it is going to the previous high. Oh yes, we are so patient. Exactly. And that's how we get an easy trade. Now from this, it is showing you one thing. It is a patient game. It's about 90% waiting and 10% execution. The problem is most of the retail traders who participate in the financial market, they execute 90% and wait 10%. And that explains why over 87% of retail market participants actually lose money in the financial market. If patience is not in your bloodline, I highly recommend you quit. This is the Blue Ball Forex, your #1 best friend and Forex coach. Goodbye for now.